What's going on, guys? In today's video, I want to go over with you how I let my options expire worthless, yet I still made money. If this sounds crazy, trust me, I know, but bear with me, I'll explain it. The kind of strategy makes a bunch of sense, and we'll break it down step by step in the video. If you're new to the channel, hello, welcome. My name is Ethan Chase. I post videos every single day on personal finance, investing, and life. By the end of the video, you'll understand what I'm talking about. I'll break down the theory, and then we'll hop onto the computer on a whiteboard to do a visual kind of exercise. And then at the end, we'll hop on the Robinhood platform and app and show you a real example using Robinhood. Okay guys, now let's hop onto the whiteboard so we can start explaining what I mean by a covered call or a put. So we're going to start with selling covered calls. And the first thing you need to do is you need to own 100 shares of the underlying stock. And I'll explain this later, but you know an option gives you the right to 100 shares of an underlying stock. So when you sell covered calls, you need to own 100 shares of the company first. And there's different reasons to that, because if you didn't own 100 shares, then the risk for what I'm about to tell you would be much greater. Let's say you have, stock XYZ, just a made up company with a ticker XYZ. You have 100 shares, and let's say you bought them, $10 a share. So you have $1,000 worth of, stock of XYZ. So XYZ, you now have 100 shares, 100 at $10, and that is equal to $1,000. I'm doing this all on my Mac, so it's a little tough. All right, so you have $1,000 worth of XYZ, and that's super important. Okay, so when you go to sell the covered call, the first thing you do, of course, is you go to the options chain and you see, what the different options are. So let's say we want to sell a covered call that expires in about a week from now. So right now it's June 20th. So next Friday is July 3rd. So you go to the options chain, you have 7-3. You have a bunch of different options expiring 7-3. Let's say you have, a $12 one that has, a premium of, let's say, 0.1, so $10. And then you also have a 7-3 at, let's say, 15, and that gives you, let's do like $5. So this is the options chain. You can find us on Robinhood. So let's say you want to sell the July 3rd $15 strike price with a premium of $5, 0.05 times 100, $5. So right when you sell it, you automatically collect the premium, which is this. You automatically collect $5. You could do whatever you want with the $5. You could withdraw it, spend it, invest it, whatever. It's yours no matter what. No one can take it away from you. So off the bat, you automatically earn $5 no matter what. Now, if you think, all right, this is free money, how could it go wrong? Well, here comes in kind of the analysis and the risks. All right, so let's draw out kind of the chart of stocks. Let's say you have stock, X, Y, Z, and let's say, so you have stock X, Y, Z, and this is your kind of 7-3 kind of date, okay? So let's say this is the price, it kind of goes up, whatever. But let's say at 7-3, it goes, let's go $14, okay? And of course, this would be your $10, is where you sold your call at $10. Okay, and then of course, you have your strike price at 15 here. Bear with me, I don't know if this is exactly the scale, but let's just go like this. So the stock price of XYZ rose from Saturday, or I guess from Monday to Friday, it rose to $14. Now, because the stock is at $14, the person who you sold the contract to isn't going to exercise that option, right? They wouldn't, buy 100 shares at $15 with the option when they could just buy it in the market for $14. So at this point, you make money, that's it. You keep your premium of $5, your option expires worthless, and nothing happens. You're done. You keep that $5, that's it. That's kind of the ideal scenario. The best case scenario is that, it goes all the way up to about like $14.99, right? You want to get as much appreciation of your stock without it actually, getting in the money where you then have to, where then the option is exercised. Because so the ideal is $14.99 because you get the $5 premium, right? Plus you get $14.99 minus 10, so you get $4.99 per share of a stock appreciation, right? So your 100 shares, they rose $4.99, and of course you have 100 shares of that. So that's how much you would get total of this trade. So that's the ideal. You want just 1 cent below the expiration price. So that's kind of scenario one. Let's say the stock kind of just goes down, and let's say by 7/3, I don't know, let's say it hits $9, okay? Well, in the same type of fashion, your option will expire worthless because no one's going to buy 100 shares at $15 when they could buy it on the open market at $9. In this scenario, you lose $1 a share, so you're down $100, but you get the $5 premium still. So you still lose money on the loss of value of the shares, but you get the $5 premium. So essentially, selling covered calls is just a safer way to go long because over time, if the company is good, the stock price will go up over time. So you'll make that money back. Now let's talk about what happens when your option actually gets called, and that's kind of worst case scenario. So let's say it starts at $10, say it rips up, and it kind of just like goes up to, let's say, I don't know, $16. Okay, let's say it hits 16. Well, now your option is going to be called. So this is going to be what happens. You get the $5 of premium. No matter what scenario, you get the $5 of premium. So that's yours. That's kind of the passive income that you generate. If, however, the stock price goes to 16 or $15.01, anything above 15, then your option will be called and you will have to give up your shares. So, you get, you get $5. Let's do 5 times 100. So that's how much you get. You'll get $505. But what you end up doing is you miss out on kind of the difference of this $1. So instead of just keeping the stock and not actually exercising the contract, so instead of just getting $600, let's say you didn't sell the contract and you just kept the stock, you would have $600 of profit, but instead you have $505. So that's the risk, is that your options actually get exercised, and you have to give up your 100 shares to whoever you sold the contract to. But it's not like you lost money, right? It's just you didn't earn as much money as you can. And the idea for selling covered calls is, you want to sell kind of far out calls where they're not going to get exercised, but you'll still be able to collect extra money over time. So that's the first part, is selling covered calls when you think a stock won't reach a certain price, and if it doesn't, then you just collect the premium. Now, of course, this premium, this $5 will change. Let's say instead of 15 strike price, you sold a 20. Well, obviously that premium will go down because people think it's less likely. So you want to balance the strike price with the premium. If you didn't already own the 100 shares, then it could get tricky because let's say if you have the 7/3 $15 strike price, but let's say the stock actually rips up and it's at, I don't know, $100, right? Then you have to buy 100 shares at $100 just to sell them back for 15, right? The stock price can go up and up and up and up to infinity, and no matter what the price is, if it's $800, you have to buy, $800 times 100 shares of that just to sell it back at your strike price. That's why it's not really recommended to sell covered calls on stocks you don't own. What you want to do is sell these covered calls on stocks you already own, and preferably stocks that pay a dividend so you can also collect the dividend. Okay, now we're going to talk about selling puts. And this is the same thing, but instead of a price above the current share price, it's a price below. And for this, you don't need to own 100 shares. This is kind of the opposite. If your contract gets exercised, you actually have to buy the 100 shares. So let's hop an example. So let's say you have, let's do this, XYZ. Let's say you don't own any shares of XYZ, but let's say it's trading at $20, okay? So you have XYZ at 20, and we could draw out kind of price. So we could do the same kind of 7/3. So July 3rd is when it expires, kind of a week from now. You have, let's say, 20. You have, let's do 15. And then you have 10. let's say, so it costs $20 and you don't think it's going to go below, let's say, $10. Okay, so that's kind of the price you're looking at. Hypothetically, a 7/3, $10 strike price, it's half the value. It probably won't have a premium, but let's just say, hypothetically, the premium, I don't know, is 0.02, so you could collect $2. So if you sell the put, you get $2 automatically. Just like the covered call, that $2 is yours. No one can take it away from you unless you go in debt, whatever. But assuming you're good, no one can take that away from you. And you don't need to own 100 shares of this, because at the end, if your option gets exercised, then you will have to buy 100 shares. So what you have to do is you have to put up collateral, and it would be 100 shares at kind of this strike price at $10. So you would need $1,000 in collateral reserved in your account in case your option actually gets exercised. So you don't need to own 100 shares, you just have to put up collateral. Let's go through the different scenarios. Let's say the stock kind of goes up 25, let's say it goes up, so it's at $25. Well, no one's going to sell you 100 shares at $10 when they could sell it at the open market at $25. So the option will expire worthless, and nothing happens. You just collect your $2 premium. There's really no difference between anything above 10. I don't think there's any difference between anything above 10, because you don't own the share. It's not like you own the share and you benefit off appreciation. The same with this. It's not like you own shares and you lose money when it goes down. So anything above 10, you're good. On the contrary, let's say it actually goes to let's say goes right here to about $10.01. Well, then again, it's not going to be exercised because they can still make 1 cent on 100 shares, which is about $10. Now, worst case scenario, let's say it goes to, let's say, $9. Well, what do you have to do? If it goes below $10, then the call or the put is exercised, and you have to buy 100 shares at $10, not at the market price of $9, at $10. So the person who is selling you those shares makes that dollar difference, right? Instead of them selling it at $9, they can sell it to you for $10. And that's the risk you take, is that the stock actually goes below your strike price and you have to buy 100 shares. So what I like to do for these types of kind of options trades is I like to only sell puts on stocks I'm comfortable with buying at that certain price. Let's say I want a dollar cost average my position down, or I'm comfortable buying 100 shares, which is a lot of a certain stock. I'm only going to do that on a stock I don't mind holding for the long run. So that's a good way to hedge your risk. So even if you have to buy the shares and the option gets exercised, you still don't mind the stock that you sold the put on. Okay, so that's a lot, but that's it for kind of the theory part. I hope you understand it. If you have any questions, let me know. But now it's time to hop into Robinhood to kind of go over the real life example and how to implement this into your. Alright, I know that was a bunch of information, but if you have any questions or you need to go back and watch the video, go ahead and do that. But again, any questions, let me know in the comments below and I'll answer them. Alright, let's take a look at SPY on Robinhood. You can do any stock or ETF. I'm just doing SPY because it's the broad market. Now note, SPY, one share is $306. So if you were going to do covered calls, you would need 100 shares, which is around $30,000. I know that sounds a lot. You don't have to do it on SPY. You could do it on cheaper stocks or any type of stock that fits your investment level and your risk appetite. But let's just go with SPY just because it tracks the market. So let's take a look. Let's say you want to do a covered call, so you own 100 shares of SPY, and let's say you bought SPY at $100 a couple weeks ago. So you own it for $100. You want to hit trade options, and then you're going to have this type of menu. You have the general discover menu, but let's say you want to be specific. So let's say you want to do, let's do that July 3rd. They don't have it, but let's do July 2nd, so a Thursday. The day before our old example. So you have buy, sell, call, put. You always want to be on sell. So let's do sell and then call. Now this is the option chain for July 2nd. You have all of these strike prices. So let's say what it's right now it's at $306.10. So let's say you don't think it's going to go above $330. Okay, so you have $330, a 31-cent premium. That means if you sell the covered call, you will collect guaranteed $31 just by selling this covered call. So you would click on it, you would have sell SPY 330 call July 2nd, one contract at a limit price, put 3-1, you would hit review, and then you would swipe up. Obviously, you don't have enough shares of SPY for the collateral needed to place the order. So if you did have 100 shares, this is something you could do. Now let's say you want to be a little bit riskier. Let's say you don't think it'll go above 320. Well, you can scroll to 320 and you'll see it has, let's go back, you'll see it has a $175 premium. So that's pretty insane. But again, you need 100 shares of SPY. So you would do 1 and 175. So if it doesn't go above $320, then your option expires worthless and you collect that premium, which is awesome. Now let's go to puts. Let's say you want to sell a put. So let's say you don't own 100 shares of SPY, but you don't mind buying 100 shares of SPY at a certain price. You would need to put up $30,000, give or take, of collateral, but if that's, if you have the money for that, go ahead. And of course, you can do this with any stock that has options available, and you can do it for cheaper stocks if you don't have that much money and you're just getting started. So let's say you don't mind buying it at, let's say, $280. Let's go down there. At $280, if you sell one put, you could get one contract, you get $108 in your pocket immediately. That's the beauty of it. But the risk is if SPY does go down below 280, you have to buy 100 shares of SPY at 280. So you have to put up $28,000 of collateral. This is a crazy example because it's SPY and SPY is expensive, but let's say you buy a cheap stock, then you can do it on that, and then you can make money by selling covered calls. If you own the shares, or if you don't own the shares but don't mind owning the company, you could sell puts. So that's it for the video. I hope you enjoyed. Any questions whatsoever, comment them down below. If you like the video, hit the like button so the YouTube algorithm can pick up on it and recommend it to others. And comment down below what your biggest takeaway was and if you're going to start implementing this in your trading career. And if you haven't already, hit the subscribe button. It takes 2 seconds and it means the world to me. And really, every subscription is another step on my journey to financial freedom.